Hello guys, welcome to our channel. Welcome to Refinance. Today I'm going to talk to you about risk and return. We are going to discuss how to measure the return and risk on a single investment or a single asset. We are going also to discuss how to measure return and risk on a portfolio, which means more than one asset. To start our presentation, let us identify investment objective function, which you learned entirely in investment class, and that is to maximize your expected return for a given level of risk, so that if presented as per our example with two options to invest in stock A or in stock B, and see here that these two stocks have the same level of risk, measured perhaps using standard deviation and returns. In this scenario, you want to choose stock B because the stock promises to earn a return that's higher than that of stock A and twice as much actually. Alternatively, the objective function can also be expressed by minimizing your investment risk. Okay, so that in this example, given that the stock C and stock D have the same expected return of 20%, and you do want to choose stock C because it promises to expose you to a lower risk, here a risk level of 25% comparing to stock D of 30% level of risk. Therefore, with that objective function in place, we assume that investors are risk averse. We also assume that investment return can follow a normal distribution. Now, the inference of this assumption here is in a sense that if investment return follow a normal distribution as seen in this frequency histogram, then you only need the mean and the variance of distribution to fully characterize your investment performance. We are going to use the mean to measure how much you can expect to earn. Besides, we are going to use the variance or standard deviation to measure your risk exposure, so that the greater the standard deviation of the return distribution, the riskier is that investment. And then that makes sense because in this distribution if the distribution is more dispersed, then it means that you are less likely to earn the central distribution. Remember, when the distribution is normal, the mean, which is the average of the numbers, is going to be at the center of this distribution, which is also the median. But observe that in the center of the distribution is also where you have the mode, which is the observation of occurring most frequently. The second graph gives you the way you can interpret your result. As you can see, your investment can face a smaller risk as your graph appears to be closer like a bell. Therefore, the wider is the bell in your graph means that the riskier is your investment. Following the above mentioned assumption, and without further, I'm going to show you how to do expected return and measure the risk of your investment, beginning with the single investment using historical data. Now, for this work, we consider, for example, data over the past 4 period of 4 years. We collected sample data for a certain investment. A year ago, it made 5%. 2 years ago, it made only 6%. And 3 years ago, it made negative 8%. And 4 years back, it made at least 10%. So to compute the return, we simply calculate the arithmetic average that we learned back in high school. Simply take the average of all the numbers, and here the result is 0.0 0.033 or 3.3%. So if you believe that history will repeat itself, then when forward, then you are saying that if you were to make this investment, you can expect to earn about 3.3%. How about risk? Well, we can use the same distribution as I explained earlier to measure how much risk you are exposed to by using the variance and the standard deviation. The definition of variance here means that we are going to have to subtract the mean from each of the possible returns. So the mean is 3.3%, subtracting it from 0.05 in the first instance and the second instance, which is 0.06, and so on. Then you must divide it by the degree of freedom. The degree of freedom is the number of observations minus 1. In our example, we have 4 observations, so the degree of freedom is 4 minus 1. Therefore, the degree of freedom is 3. The final answer is 0.006, and this is our measure of the absolute risk of this investment. Well, if this value was 0, it means that we have absolutely no risk to that investment. This number represents the overall risk exposure. So you can compare the variance of 2 or more investments so that one with the highest variance has the largest risk. But looking at the variance of a single security, we cannot say, well, if its risk is too high or too low. We must compare with other securities to make this conclusion. Furthermore, variance cannot be interpreted with a unit because variance is a squared variable. You must leave the number as it is, as you do not want to say that this is equivalent to 0.006%. Please try to correct that stuff like that. Typically in statistics, you do not apply a unit of measure for variance, despite what you receive from some financial textbooks. If you want to impose a unit of measure, then calculate the standard deviation. Standard deviation is the square root of the variance. So by taking the square root of the variance, you actually calculate the standard deviation. And therefore, you can impose a unit of measure so that our final answer here is 0.0774 or 7.74%. And naturally, most investment analysts will use standard deviation as the final and most recent measure of the risk of investment. Coefficient of variation. You can also calculate the risk of an investment by calculating the coefficient of variation, which is simply the standard deviation divided by the expected return or mean. Here, it comes out to be 2.35. So, by looking at the standard deviation concerning the mean, you are simply trying to calculate how much risk you face per unit of return. And in this example, you are facing 2.35 unit of risk for each unit of return. The larger this number is, the greater your risk exposure for every unit of return that you are expecting now. What I showed you so far can be calculated using an Excel spreadsheet and the appropriate function. I will make a special video to show you how to use Excel to compute the above mentioned variables. If you believe that history will repeat itself, then the way to measure risk and compute the expected return are as we have shown you in the previous slides with the historical data. Nevertheless, if you do not believe that history will repeat itself, as it is often the case, then you must use probability data. This means that you consider some principle in the economy that may occur going forward, then make a judgment as to the likelihood of the occurrence of each of these economic situations. In our example, we think there is a 20% chance that the economy will falter or go into recession, 30% chance that it stays normal, and in this situation, we will have moderate growth. And we also think that it has 50% chance that the economy will have a strong growth. Remember that the sum of your probability values must be equal to 1. Based on this and some other analysis, we are projected that if the economy weakens, we could lose as much as 8% of a certain investment. But if we have a moderate growth economy, we can expect to earn 10%. Besides, if the economy will really boom, our expectation is to earn as much as 20%. With this in view, we can compute our measure of risk and return. To compute the return, we use the mean of the probability of return, which is defined by the sum of each possible return multiplied by its corresponding probability. By applying the formula, we found that the expected return for our sample is equal to 0.114 or 11.4%. This value means that you expect to earn about 11.4% on your investment. What about for risk? Variance and standard deviation. This is the variance of the probability distribution here. Remember, with probability distribution, you do not divide by the degree of freedom or n observation minus 1. Rather, for each of the squared outcomes you have in the variance equation, you must multiply by the corresponding probability. So for each return, you subtract the mean, square it, and multiply it by the corresponding probability. Besides, that is what I got here. So this is the means subtracted from the first return of 0.08 minus 0.114 squared and multiply it by 0.2, which is the corresponding probability. One more time, do not try to put a unit of measure after the variance value. If you want to use a measure as a percentage, please let's follow suit by computing the standard deviation, which is widely used by respectable financial analysts by taking the square root of the variance. And the answer is here 8.9%. Also, you can compute the coefficient of variation, which is gonna be the standard deviation divided by the expected return, as we showed you previously in the calculation when using historical data. This is all we have to show you today about the management or about the analysis related to measure the return, and we hope this information are useful for you, and we hope that to see you in another video. And please remember to subscribe to our channel.